I speak from experience when I say that your first option trade can result in a 100% loss. And this experience can leave a sour taste in your mouth about trading options. But if you follow the best practices and strategies I will be outlining, you'll improve your risk to reward on your options trades. In this third video in the options series, we will focus on trading options by buying to open and then closing the option out by selling to close after making a profit. So far in the month of April, I've made over $9,000 trading options in this manner. I have done so with both puts and calls on a variety of stocks and ETFs. Today we will look at some charts and options chains for the VIX, Tesla, the Qs, RIOT, and UNG for a wide variety of asset classes. These are all educational examples, and none of these are specific recommendations of things you should buy or do. As a quick recap, in the first video in this options series, I discussed why options are so versatile and beneficial. They're kind of like a Swiss Army knife of potential strategies. In the second video, I walked through how to utilize cash-secured puts and covered calls and a strategy called the wheel to collect premiums on your long-term holdings. Both of these strategies are sell-to-open strategies where you are the seller of the option to start out. Today, we will be looking at being the buyer of options by buying to open both calls and puts. I will be giving examples in various price ranges of both puts and calls. If you're new here, welcome, and if you've been here, thanks for sticking around. I create content to help you reach financial independence more quickly. I have many new videos on the way on a variety of topics, so please consider liking, subscribing, and sharing. Remember, when buying an option, the most you are risking is your premium for buying the contract. If you were going to hold the option until the expiration date of the contract, there would be three things you would need to get correct. Those would be the direction, meaning whether you bought a call or a put, the magnitude or the strike price of the option, and the time frame of the move of the underlying security represented by the expiration date of the contract. Getting those three things right is extremely difficult, and it's not very repeatable. I think that you can reduce the three things to get right down to getting only one thing right, the direction, if you buy in the 3 to 6 month or longer time frame to expiration, so that all you have to do is get direction right to make a profit. So before you start to look at an option to buy, look at the chart of the underlying security and get an idea of whether you are bullish or bearish, and look for potential price targets for the move you are expecting, and also a reasonable time frame for that to happen. You do not need a big move to make a good profit because options are leveraged derivatives. You are using a small premium to control 100 shares of the underlying security so you can amplify your profits. After looking at the chart, you can buy a call if you are bullish and expect an upward movement, or a put if you are bearish and expect a downward movement. I think in general that buying an option to hold till expiration and or exercise it has less benefit than buying with the intent to trade. That is because when you exercise the option, it takes a lot of money, a lot of capital. You pay a premium for the option, that increases the price that the underlying security needs to reach to break even if you're going to exercise and buy the underlying shares. So I just focus on trading the option away at a higher premium than I bought it for, and I just would start out with targeting 5 to 10% profit. Focus on not getting greedy, following your trade rules and trade plan, and just repeating this process over and over to limit your risk. I think many traders, when they start out with options, me included, are swinging for the fences and frequently strike out. But let's just focus on hitting singles, getting on base, and do that by buying in the money or at the money options and giving ourselves time for the move we are expecting to play out. As you recall, when we are selling to open, we want to take advantage of time decay, and that occurs the most in the last 30 to 45 days before expiration. With that fact in mind, as the buyer, let's try to remove time decay as much as possible when learning, and let's stick to options that are at least 3 months out to 6 months out or longer until expiration. Let's also, as I mentioned, just target the 5 to 10% returns and then close out the trade to practice and get the hang of the strategy. You can eventually scale up the position size and you can aim for higher returns, but to start, just use a small percentage of your account and familiarize yourself with buying to open and selling to close when you have a gain. Let's first start with a chart of the VIX. You can see here this is on the weekly time frame, and this is a volatility gauge for the S&P 500. And what we're looking for on here is whether we should buy calls or puts on the VIX. And how I usually decide that is looking at the channel commodity index. So when the channel commodity index is below the 100 line, that would be a time I'd be looking to buy calls. And when it's above the 100 line, that's the time I'd be looking to buy puts. So just objectively right now, we're down, we closed in the 16s, I think. And historically, when we've gotten down that low, that would be a great time to buy calls on a longer term time frame because volatility is likely to increase. So I've determined that I want to buy a call. And when we're the buyer of an option, we don't want time decay to take advantage of us. So we're going to turn off the weekly options and view all expiration dates, and we're going to get rid of these that are within 2 months out. I'm even going to eliminate July. I'm going to look at August or September, and I'm just going to apply that. And so I look, if I were buying calls on the VIX and I wanted to give myself a good risk to reward, I'd probably buy the August contract for 15. And to remember, you're multiplying by 100 to get the cost to do this, and it's between this bid and ask. So you probably have to pay $830 to buy one contract. I'd probably buy one contract, and I would wait for the VIX to go up. So when the VIX goes up, all of these premiums are going to increase, and then you can trade it away by selling to close. So you buy to open at 830. Let's say the VIX goes up, it goes to 950 for this contract. You just made $120, and you can just close it. And so that's what I do, is I just pick stuff that's far out, that's liquid, and I don't buy out of the money. I've gotten hurt in the past doing that, so stay away from buying out of the money when you're first starting out. Just look for high probability trades after looking at the chart. That's probably what I'd target here, is probably the stuff that's in the money in the shaded blue area here. It has intrinsic value already. Here we're looking at the chart of Tesla, and this is on the daily time frame. You can see that there's a gap in price still in the 144 area. There's also a gap after the earnings last week in the upper area. So you could choose to play either of these. Let's say that we were bearish right now because of the earnings, and we think that it's going to go down and fill this 144 gap before it goes up and fills the upper gap. And that could happen. Not saying that will happen. And so we'll look at some puts. Since we looked at calls on the VIX, we'll look at puts on Tesla and just look at what we could target for a high probability trade. So then we switch over to the Tesla option chain, and we said we wanted to look at puts. I'm going to turn off the weeklies. I'm going to look at August and September. Seem like decent dates, and I'm going to apply that. And so this time, since we're looking at puts, we're on the right side of the option chain here. And you can see that to buy one contract for Tesla, if you're buying an in the money, and that's what I would target buying, I'd buy an in the money put. So you'd need around $2,360 or so to buy one contract. And you buy your contract at $2,360. If Tesla were to continue down to 144, all of these premiums here would increase. So let's say your $2,360 that you paid goes up to $2,500. So the next price down, you can see is $2,665. So that would increase, that would increase, that would increase. You just would take your profit at $2,500 in this example, and then you could look for your next trade setup. So you're not trying to hold this till August 18th. You're just targeting 10% profit. What would that be? $230. Next up is a chart of the Qs. We're on the weekly time frame. You can see that we are in overbought conditions on the weekly time frame, and in the past gets up here, and then you get a kind of a reversion to the mean eventually. Not saying it's going to happen right now. Not saying there's more room left to run, but let's say we wanted to buy a put, and we could even be doing that for downside protection on our long position, hedging a little bit. And so we're going to be looking at some puts on the Qs. So here we're looking at the options chain for the Qs, and I'm again going to turn off the weeklies and look at view all expiration dates. Since we were looking at the weekly chart, we could even look further out than we were for the price movement. So let's go out to December just for giggles. You can see that the further out you go, the more money you need for your premium. This is why many people choose to buy shorter time frames and lose their money to time decay, is because if they've only got $200 or $300 to buy the option and the premium they can afford is for something that's out of the money and soon, then they buy that. So don't get lured into that trap. So let's say that we think that by December the Qs are going to be below 300, and we want to target this by buying a put. I'd probably look at a 320 put ending December 15th. You can see there's a lot of open interest here and a lot of open interest at 315. People like the multiples of 5. So I'd probably buy the 320. You need about $2,135 to do it, and then a 10% profit. You'd be looking at $2,350 or so. So I'd just be looking for a downward movement in the Qs, and then you could even do a sell to close, good till canceled, and set the limit price that you want to sell at, and then it would exit the trade and you wouldn't even have to really monitor it. Here's the chart for RIOT blockchain. It's on the daily time frame. You can see that we're coming off of overbought conditions, and the channel commodity index was elevated. The relative strength index was even overbought. That happens pretty rarely for this one. Those would be great times to buy puts. So right now it's actually in between, overbought and oversold. I would not enter either side of the trade. I wait for a setup that is very clearly overbought or very clearly oversold before I enter. So I actually wouldn't buy anything on this right now. So this one we're just going to pass at the moment. And here's natural gas on the monthly time frame. So big long time periods. We're going back till 2010 here. You can see that we are very oversold on the monthly time frame, and there's not to say that we're going to shoot back up at any time in the future, but in the past when it's gotten into these oversold areas, it's been a decent time to buy some long-term calls. So we're going to be looking at some long-term calls on natural gas. So here is the option chain UNG. I'm going to turn off the weeklies. And I said long-term time frame. So I'm going to look at a couple of years out. So we're looking at January of 2024 and January of 2025. These would be considered leaps. So you can see that on the call side of things, this is where we're living. There's already a lot of open interest, even 635 days in the future. If you were betting that natural gas would go up in the future, you could buy some $5 strike price January 25 calls for $375 and just hold on to this. And if natural gas were to, double in price, if it were to go to $14, you'd make pretty significant return on that money, not in terms of dollar amount, but in percentage. And you can buy a high number of contracts. So let's say you bought 10 contracts, that'd be $3,700, then you'd have a little more dollar return. But when you're just learning, something like this would allow you to see how the options fluctuate and move over time, and with relatively little capital at risk. I think that about wraps up options trading for the time being. Try to use those strategies on your own holdings and let me know in the comments what's working or not working for you. More videos to come, so till next time.